There are two mistakes that I believe every investor has made. Number one is buying a stock because you believe it is undervalued and it keeps going lower. Number two is selling a stock because you believe it is overvalued and the stocks keeps going higher. Both of these mistakes can be solved by looking at just one chart. So what does this chart tell us is that there are only a few factors that really affect the stock price of any business over the short term, 1 year, 2 years, and also over the long term. And you will see that the most important one in the short term are multiples. If a stock is trading, let's say, at 10 times earnings, you buy, tomorrow the stock goes at 20 times earnings, you have double your money. Nothing has changed in the fundamentals, but you have doubled your money. And this is why value investors make the mistake of buying value traps. They bought a stock at 10 times earnings because they believe it was undervalued. It goes to 5 times earnings. They lost 50% of their investments. Multiples are the most unreliable part of investments. You can sell a stock because you believe it is trading at 25 times earnings. It goes to 50, like Costco. It is a wonderful company, but at 50 times earnings, most people will say it is overvalued, but it keeps going higher. That's not really a problem. What we need to focus on are the things that we can have control on. And that is the fundamentals. We can read about the company, things we can understand. The better we can predict what will be the revenue growth rate of the company. As you see on the chart, this is what affects the stock price the most over the long term. And also improvements in margins. And the free cash flow part, let's not talk much about it because it matters only if you're looking at the GAAP earnings and free cash flow separately, but I don't do that. I look at my own owner's earnings. And if you think about it, it makes sense. You're buying a company. If the revenues are going to increase, the company is selling, let's say, shoes, 100 million worth of shoes this year. Next year they are going to sell 150 million worth of shoes. You expect that the company will be worth more. More sales means the company is bigger. Margins are also important because if the company is spending too much money to sell these 150 million shoes, they are now losing money. It's going to destroy value for owners. That's why if a company can increase sales by not sacrificing earnings, it is going to create value for owners. A better company will increase both sales and earnings. That is by improving margins. There are many of the investments I have in my portfolio that can do that. For example, Celsius, which is a company growing very rapidly. And I believe that over the long term, the margins of the company will increase. Because the more energy drink they can sell, the less the expenses to sell each of these cans will be because of the big volume. Same for Wise. Wise can increase revenues, but I believe that through value-added services, margins are going to increase over the long term. So it is creating value for owners, both from revenue growth and from margin improvements. And if we want to talk about free cash flow, why this is important, because you can increase GAAP earnings. For example, companies like Microsoft, Meta are doing this, but free cash flow are going down. Let's hope, of course, as owners of Meta, I hope that it's going to be only short term. But this matters because eventually the company will need to return excess cash to owners. What Wise has been doing, I have a talk about the latest earnings of Wise. They are repurchasing 500 million worth of shares. It's important that we don't just look at earnings, but also cash flows. I prefer using owners' earnings, which takes both into consideration to some extent. Another way you can look at it is the company is not just capitalizing expenses. The big hyperscalers, they are doing that. They are capitalizing expenses. We don't see the expense today, but in the future, there will be depreciation. Wise is doing the opposite. They are expanding today, and in the future, there won't be that much depreciation. Next time you buy any company, what you need to focus on is, of course, the fundamentals, how much they can grow revenues. If they tell you 20%, don't assume they will grow at 25%. Don't even assume 20%. Be conservative. If they can keep growing, that's good. Same for margins. They say they are going to make 20% margins. Let's assume worst case scenario, 15%. Can value still be created for owners? If it is undervalued, then it might be a good investment. Multiples are the last thing because this is something you don't really have control on. This is Mr. Market. If the company is trading at 10 times, it trades at 20 times, nothing changed, you cannot do anything about it. I'm not saying that multiples don't matter. Multiples matter, especially if you're holding a stock that is now becoming overvalued. If, let's say, all the value that you wanted to create from the company based on fundamentals alone has been created, You cannot just sell if it is a compounder. This is a mistake I have made. I have sold compounders too early. Apple, I have sold too early. It's a compounder. It keeps getting higher. And if the market believes that they were wrong, there's always an overcorrection. Just because you're conservative doesn't mean that the market will be conservative. At some point, the stock price will be higher than the intrinsic value you calculated. And if it is a compounder, and if it can still keep growing revenues, it can still improve margins like Apple has been doing, why would you want to sell? Of course, if it gets 50% of your portfolio, maybe you want to trim. There's another company in my portfolio which I believe can improve margins and grow revenues rapidly. That is dLocal. I will recommend you watch this video next. Have a nice day and goodbye.